Hello and welcome to Forex.Academy, your #1 website for Forex and crypto education and analysis. In today's edition, we're going to be discussing position sizing part 5, optimize your returns using the percent risk model. Besides the constant position size, the percentage risk model is the most used method. The percentage risk model allows us to define the number of lots or mini or micro lots as a fixed percentage of the available cash in the trading account. The risk is defined as the loss incurred if the trade hits the stop-loss order. Thus, every trade must have at least a predefined entry and stop-loss. The monetary value in pips from the entry point to the stop-loss is the risk of the trade. The size is determined by MCP simple formula, as already stated in the previous video. M equals CP. M is the number of mini lots, C is the cash at risk, or the percentage of risk decided by the trader, and P is the pip distance from entry to stop-loss. C, the cash at risk, can vary widely and it will determine the profitability of the strategy and also the max drawdown incurred. From the MCP formula, we can deduct that M increases as P decreases, so tight stop loss would allow the trader to increase M without increasing the dollar risk C. But before analyzing this methodology, we have to emphasize the stop loss setting must be set at an optimal place. Setting them too close to the entry to increase the position size will force the trader to close a position that would be profitable with a proper stop setting. In our site, Forex.Academy, we have already published several methods to optimize stops. We recommend you give them a good look. Links to these will be found in the description below. The constant size risk model. The percentage risk model is a compounding method. The constant size trading method uses a single size, independent of the amount of cash available. The first one is that the size of the position does not decrease on drawdowns. Imagine a trader risking 1/10 of the initial cash, experiencing a 10 losing streak. He will be wiped out. Also, if he is successful, this position sizing method does not allow him to use the money gained in the markets to make more profits. Thus, it is much more difficult to create wealth. To see the importance of compounding, let's look at the difference between a constant mini-lot size and a compounding 1% risk in 1 year of trading using the trade signals of our live signal service. We will start both cases with $10,000. In the image, we can see that while the profits of the constant sizing methodology are linear, the equity curve of the percentage risk model is exponential. We can also observe by the ripples of the curve that the percent risk model has higher drawdowns, which grow money-wise with the trading account's growth. These are the main features of these sizing models. Optimizing our percentage risk model. The figure below shows the hypothetical position sizing curves of 1%, 2%, 5%, 10%, and 20% risk models in long scale. For the same segment of the trading system with 68% of winners and a 1.1 reward risk factor, which shows similar figures to our live signal service. We can see that the theoretical account growth can be made astronomical by increasing the position sizing. Unhappily, the future is not written in stone, and our future returns can vary substantially from past performances. Thus, the trader must set their trading goals to take into consideration not only the growth but also the drawdown. For instance, the figure above the steepest curve corresponding to the 20% risk model shows several 90% drawdown segments. Are you willing to accept to lose 90% of your hard-earned profits to push your returns to the sky? Indeed, there is a limit to the amount the trader can withstand to lose. Thus, it does seem reasonable to define our desired maximum drawdown and set the percentage risk accordingly. Let's say that our risk appetite allows us to lose up to 25% drawdown, and that our system is well below 10 losing streaks. An approximation of our ideal percent risk model size is to divide 25% by 10 and set our trading size to 2%. To verify this figure, traders with programming abilities could create a code to produce a Monte Carlo simulation of future trades. This is what we have done here. The curve corresponds to the drawdown of the histogram of 10,000 synthetic historical trades. Our little exercise tells us that the average max drawdown is 21.02%, but there is a 3% chance that we could experience a 30% drawdown in a year. A small sacrifice to convert $10,000 into $2.5 million in 12 months. In a future video, we will discuss the improvements on this basic model. If you enjoyed the video, then please like and subscribe and leave a comment down below about anything you would like us to discuss in future, or if you have any questions about this particular video. Have a great day.